Zenith Bank PLC says it has complied fully with the Central Bank of Nigeria's guidelines on the temporary suspension of dividend payments, bonuses and investments in foreign subsidiaries. In a statement issued on Tuesday, June 17th and signed by the bank's company secretary, Michael Otu, Zenith Bank says it has successfully raised and surpassed the new regulatory capital requirement of 500 billion naira. According to the statement, the bank's exposure under the single obligor limit forbearance relates solely to a single obligor and expressed confidence that this will be brought within the applicable regulatory limit on or before June 30th this year. With respect to the forbearance granted on other credit facilities, Zenith Bank also confirms that these apply to only 2 customers. The bank stated that it expects to have exited all CBN forbearance arrangements by the end of the first half of 2025. And it shows shareholders the bank will satisfy all relevant conditions to enable it to pay dividends to shareholders in the current year. And of course, Arise business anchor Rotus Oddiri joins us now for a breakdown of the statement from Zenith Bank. Rotus, always a pleasure to have you.
Cynthia, good to see you all.
Afternoon.
Good to be here.
Good. So for the benefit of the viewers, can you break this down for us? What's regulatory forbearance?
Yeah, so forbearance is leniency. It's a reprieve. And with respect to regulatory forbearance, it is basically giving entities that are being looked at by a regulator a break. So it's essentially, you've got a number of rules that banks have to play by. Your capital adequacy ratio, for instance, you have to have enough capital as a buffer to withstand shocks. That's 15%, for banks of a certain size which have an international license. Then you've got non-performing loans, which is about, I think, 5% threshold. So out of every 100 loans, I can have more than 5 going bad. Yeah. So that's essentially what it is. It is just a break on particular rules that are put in place by a regulator for players in the sector.
Okay, fantastic. Let's talk about the impact. How might this reshape competitive dynamics in the Nigerian banking landscape over the next 2 to 3 years?
Well, it's about transparency, right? So the central bank wants to clean up the sector. So just do a background how we got here. If you go back to the COVID period, but businesses were shut down, there were lockdowns, and, well, some people couldn't pay their loans, right? So look at the top left of the screen. There was the introduction of regulatory forbearance amid COVID-19. The banks some of them were in breach of these regulatory thresholds. So that's why they got the forbearance reprieve. March 2021, there was an extension of that regulatory forbearance. I think they extended it to it was supposed to be like December of 2024. It was then extended again up to where we are now. You can see September prohibited banks from using FX revaluation gains. That's basically when the Naira went from 400 to 1,005, some banks were sitting on US dollars. The central bank said you cannot use the revalued gains, and Cynthia is a lover of dollars, so she knows what I'm talking about. You cannot use your revalued gains. So the bank of Cynthia was sitting on a pile of dollars. It were valued at 400, now they are 1.5. CBN says to the bank of Cynthia, you cannot use these revalued gains to pay dividends. And then June 2015, the central bank now puts out that release saying that you cannot pay dividends. So look, to answer your question, it is going to be good for the banking sector because we are recapitalizing, right? Yeah. The central bank has a new thresholds in order to allow banks in Nigeria to be able to handle big ticket items because the administration wants to get to $1 trillion economy in a matter of years. So for the banks to be able to fund those big ticket items, they need to have bigger balance sheets. And with bigger balance sheets comes larger risk-weighted assets. And with larger risk-weighted assets comes more risk. And so the central bank is like, okay, listen, we want to get bigger banks here. We want to have larger ticket items. We want to reduce risk. So this is a pathway to getting there. Let's clean out some of these bad loans and clean out some of these other issues and get to where we need to be.
So predominantly, banks operating under forbearance measures will be mostly impacted here?
Yeah, so and this is the thing, right? Everyone wanted to know who the banks were. Now, we had Renaissance Capital Africa on the morning show yesterday, an analyst that had written, actually analyzed based on estimates, right? So let me give you an example. We should have, I think, forbearance as a percentage of gross loans. So there should be a chart or either an absolute value. One of them will pop up here. Okay, perfect. So this is a good example of what we're talking about in terms of Nee's question as to who's been impacted. Estimated forbearance exposure as a percentage of your gross loan. So I keep using the Bank of Cynthia. Totally, as your total loans. Yeah, let me stop saying that. Let me go with the banks that are on the screen. So as a percentage of the total loans that you have given out to businesses and individuals, this forbearance, right, made up, estimated from Renaissance Capital, 23% of Zenith Bank. And since we're talking about Zenith Bank, you can see that they have the highest estimated exposure of everyone else. In second place is First Holdco, parent of First Bank. Third place is Fidelity Bank at 10%. I think fourth place is FCMB at 8%, and then you've got UBA at 6%. Notice GTCO and Stanbic are at 0, right? So so basically, if you have such a large exposure of your gross loans, well, that means that you have a large exposure to risk. Basically, exposure means that the loans could go bad. Now, if you're wondering who this exposure is to, it's mostly been to the oil and gas sector. I think manufacturing is in there, the power sector as well. Think of all the loans that are owed by discos and so on and so forth. So that's basically, what you're seeing there in terms of the risk of exposure for these select banks.
That makes a lot of sense. But how might this regulatory shift influence foreign investment appetite for Nigerian banks, especially given the pause on offshore expansion?
Perfect example is how the stock market has reacted to this, to get a view of, and I know there's mostly domestic investors, but we still have foreign investors that are playing here. Now, take a look at this chart. This is, or table rather. Today is Wednesday, so we're only looking at Monday and Tuesday, right, in terms of how the banks. So everything you're seeing in red are the losses in the share prices. In green are the gains. So Access Holdings fell 8%. So investors, initially when this came out on Friday, they were worried. They were like, okay, so they're not going to be paying dividends. Well, okay, then let me just sell off on these stocks. So you can see the red there, but GTCO and Stanbic, as we mentioned, since they didn't have much exposure, they were flat when other banks fell, and they actually rebounded yesterday. But in terms of investors, to directly answer your question, investors will like that because one, they want to know that they are investing in banks that have reduced exposure to loans going bad and banks that are emerging from this forbearance phase out in better shape than they were before they went in. So for any investor, I hope the two of you invest in stocks in Nigeria. Okay, fine, don't tell me. But for anyone who is invested in any sector in any country, you want to know that the players in the sector that you are investing your hard-earned money with are going to give you a return. The return that you get is based on the operations of those players in the sector, and the operations of those players in the sector that you are investing in are basically going to be determined by the business environment, day-to-day, and so on and so forth. So for the banks and for the investors who, and by the way, they have rebounded today. Zenith is up, I think, 4.3% last I checked. UBA, all the other banks are up. So the investors are reacting positively because the bank is coming forward and saying, listen, this is what, although they didn't give us the number. I mean, you saw in the press release, they said it was the single obligor limit is, just to explain that, is essentially an obligor is a borrower, right? So you are not supposed to have, I think it's 20% of shareholder funds breached by your obligor limit, essentially meaning that how much you borrow to one particular entity, whether it's a business or an individual, should not be in excess of 20% of your shareholder funds. And shareholder funds are critical because they're the people that are investing in your business. So they were not specific. They didn't tell us who the entity was. They said it's only one entity that they have their single obligor limit exposed to, and then there's two other credit limits. But by and large, the fact that they've come forward with this press release, and we expect to see more press releases from other banks that are impacted, transparency is always a good thing. So I was checking the numbers. By the end of, we've been checking the banking stocks now every day. We'll update that table with Wednesday, Thursday, Friday. I suspect you'll see banking stocks fully rebounding today, not to jinx it.
Yeah, talking about rebounding, let's just stick a little to Zenith. What was the worry about it? Because we have the figures you're bringing up.
One, I think let's put the other one. So one was the gross exposure to forbearance as a percentage of gross loans. The second one, if we put back, we'll get that chart. The second one was the in absolute terms, that's in absolute raw numbers for Zenith and the exposure. So this day newspaper had a headline where they mentioned that First Holdco's exposure was $887 million, right? Zenith, the estimate for Zenith was double that. There it is. So it was 1.6 billion USD. You can see
the
first, there's the highest one, right? And the Zenith, first hold call is 887. Then you can now see who is in third place. Access at 304 million, Fidelity at 296, UBA at 282, FCMB 134. Again, you see GT and Stanbic at 0. GT already went forward and paid. They cleared out they phased out of the forbearance. They already cleared out the loans, whatever. They made the provisions they had to make. And so that essentially, to answer your question, that was the worry for Zenith in that, okay, wow, this exposure is high. We hope it doesn't lead to any further problems. So the bank coming out quickly and putting this out there, that's supposed to calm nerves in that respect.
Okay, let's look at some lessons. We understand that given that forbearance was introduced as a COVID-19 response,
That's right,
but extended well beyond that.
That's right.
Excuse me. What lessons does this offer about timing and exit strategies for emergency regulatory measures?
Well, I think the CBN has been pretty flexible, right? Because this is 5 years after COVID. You really should have cleared these things up. Just speaking to the banks now, before then. But then because COVID didn't end in 2020. I mean, we got out of the pandemic in 2020 and reopened businesses, but you still had those after effects. In fact, you can still argue in some economies, like in the Eurozone, because of how energy prices spiked after the impact of Russia invading Ukraine. Yeah. There's still some COVID after effects. Even in South Africa, you can make that argument, right, in terms of rebounding. But the lesson here is that, well, regulators have to react quickly to provide assistance to businesses when you've got an exogenous shock like a COVID-19, right? And in addition to being quick on the draw like the CBN was, you've also got to be flexible because, these rules, capital adequacy ratio, non-performing loans, they are put in place to make sure that you don't have terrible losses if things go bad in your particular sector. But I mean, the two main lessons for me would be, one, you have to have regulators that are quick and move quickly to support the sector. And then two, you got to be a bit flexible to give them some breathing room. But that's what's about to end with this June 30th deadline where they're saying, okay, listen, you got to get this cleared up. Because remember, the recapitalization drive deadline is March of 2026, where you're supposed to have these larger capital buffer. And by the way, Zenith, as you mentioned, as you read in the rundown there, Zenith has exceeded their 500 billion, so they're good, in terms of getting there. So that's the pathway. So it's being quick on the draw and being flexible.
So, potential investors, I'm not talking about even the foreign ones here in Nigeria, when they see things like this, how are they confident about the banking under this? I
mean, the CBN put out another press release yesterday, and they basically, affirmed that the banking sector is sound. I mean, do you even need the CBN to tell you that? If we all have bank accounts, right? How your money is there when you go to us? They don't give you stories when you go to withdraw money, or your banking operations happen. They're smooth, so to speak. So
actually, when it comes to digital issues,
there's I get you. There's the network and so on and so forth. But by and large, because of the measures that have been put in place by the regulator, Nigeria has a sound. And by the way, Nigeria has a sound banking system, and if you want proof of that, you can look at the volumes on the stock exchange. The banking sector, the banking and finance sector is the most active, has the most active sector in the exchange, the most shares that are traded there. And I mean, think of how important banks are to everyday. Think about it. You need loans for your business. You need to be able to do this and that. So it's strong. The banking sector is pretty solid, and it is measures like this that CBN is putting in place to make sure it's sound and make sure you give investor confidence. So the domestic investors outweigh foreign investors on the NGX. And so to answer your question, domestic investors, they like what they see in terms of our banks.
Okay, broader economic implications. How might this banking sector cleanup affect credit availability for Nigeria's real economy? Talking about the SMEs and infrastructure projects.
So we need more loans going out to your mom and pop stores and the everyday individual on the street. We all know, everybody has each of us in this room, including our very brilliant camera people here who are digital guys and girls. everyone has an idea they want to put forward, but one of the issues that we continually see with SMEs is access to finance, right? Everybody's using well, not everybody, but most people are using the bank of mom and dad. Before you want to get your business off the ground, you usually go to friends, family, So yeah, we need to get more loans out to the average Nigerian and businesses, but the loans have to be affordable. They are not. And in fact, it's very, very interesting that Governor Cardoso, he made a very pertinent point. It was sometime last year. I can't remember where he was. He said, you can't fight poverty if you don't fight inflation. And, and I know inflation is decelerating. 22.97 for May is the numbers that we just got. But as long as you have high inflation, you'll still be fighting poverty, and you will still be fighting the issue of expensive loans because of the cost of doing business. Banks having to, diesel, electricity costs and all these things. And then the issue of not having a centralized database where if Nee or Cynthia wants to get a loan from a bank, you can just punch up their information immediately, know where if they're having existing loans elsewhere. So banks are very afraid of defaults, and so all these are all the things that mix into them not being able to extend loans to the average, because the people who are really getting these loans are the bigger businesses that are proving themselves, and the big millionaires and billionaires in Nigeria. So that's a great point. We do have to make sure that we have affordable credit. Look at the United States. What, 60-70% of the U.S. economy is credit, right? And same thing in Europe and so on. So Nigeria has to get it. Now, to be fair to the administration, Credit Corps, they've set up Credit Corps, which is supposed to be an entity that is supposed to be handing out loans. You've got NEL Fund, which is supposed to be giving out, I think it disbursed something like 50 billion or so to about 290,000 students or so. So they're trying to they're doing credit to students. They're trying to set up Credit Corps. We need to sort out mortgages. I mean, what is the Nigerian dream? You want to finish school, get married, and have a nice house with an affordable mortgage you can pay off for like 30, 40 years. We need to get there. So the Ministry of Finance Incorporated, MOFI, has a real estate a fund that they're trying to put together. So the administration is trying to do these things, but it's coming from the administration. You still need the private sector side to buy in. Look at the news with Dangote announcing that it's going to bring out 4,000 CNG trucks. The administration has a CNG initiative. You need players from the private sector to buy into that. So that's how the credit thing is supposed to be able to work, to be able to make sure you get affordable loans out to everyone.
Will you invest in the Bank of Cynthia that you talked about?
I would invest in the Bank of Cynthia. Yes, I would.
And do the honors.
As long as
you give good loans, the Bank of Cynthia has to give affordable loans to people who are, who want to finance their dreams.
Very good, Rotus Oddiri. Many thanks for your thoughts on regulatory forbearance exposures, breaches of single obligor limits, and the highly educative as well. I just learned one or two things as well. It's good to have you with us.